Good morning, everybody. It is November 24th, 2020, a couple days before Thanksgiving. And this is the first covered call. So we're going to talk about selling options, particularly covered calls, but also selling cash secured puts when that makes sense. And I would just like to point out that I am running fundamental trends as well as margin of safety investing over on Seeking Alpha. And details for the call can be found right here in the blog on Seeking Alpha. So I hope you join us there. The covered call is based on the retirement income options portfolio that I have used in the past and used for a handful of people now. And it's really a large portfolio, generally $500,000 in size and above, but I think you can do it in the lower six figures as well. Certain stock positions won't work just because options are traded in lots of 100 and certain stocks are difficult to trade that much of. But the covered calls, I think, can be a very viable strategy in general. And I think that right now, given how expensive calls are and how overextended the market is and how out of touch valuations are with future earnings, I think that covered calls probably make a lot of sense for a lot of people right now. I think it's a very good tactical trade at the moment. And we're going to walk through when to make these trades, which stocks to make them on, how to position size. So it'll really be a good walkthrough of what we want to do. Over here, I have some reading material, and I really think you should read the stuff by Fidelity. It seems to be the best one that I found at a brokerage. They talk about what to do when you're long a stock and you want to take a little bit of your risk out and create a little bit of income. The idea behind a covered call is that you are essentially neutral on the stock in the short term, and you want to, without selling the position, get some income out of it. And these strategies work really well when options are expensive, which generally happens when the market is overheating. So that sounds like it is right now. So if you go over here to the retirement income options portfolio on fundamental trends, or you can find the same material over at margin of safety investing, you can jump to our very short lists. The very short lists are our watch lists, and take a look at some of the companies that we are following. And I have charts for some of them, and I update them periodically. But you really should have your own TradingView account or charting software so that you can do the same things that I'm doing, look at the same things that I'm looking at, so that you know when you want to sell a covered call. So the stocks that we have on our main trading list right now, and this will change in January. I'm going to replace about 6 stocks on both lists. These are the companies that we've really been involved with the most. And for a lot of you, you own a lot of dividend stocks. Now, interestingly, the dividend stocks are not bid up as much right now as the growth stocks, but that has been changing recently. So we're going to take a look at some of these stocks so that you can say, okay, this one seems a little overextended, a little overbought, and I'm going to sell a covered call to take some of my income out. The easiest way to track that is with Stock Rover. It's what I've been using. You go to the Momentum tab, and you rank by relative strength index, which is based on the daily relative strength indexes. So it's not the longer term, and we'll do some comparisons so that you understand how that works, how to read the charts, and know when you should be selling a covered call, which essentially amounts to when you feel that a stock is overvalued, or you look and see that a stock has been overbought relative to valuation, that's usually when you want to sell the covered call. I know there's the idea that you buy a stock and immediately sell a covered call. I've never subscribed to that. I think that if your stock selection is good, you generally want to buy when it's cheap over sold in general and over undervalued. And you want to let it rise a little bit. And sometimes your stocks get out of control and they go past what they probably should be in the short term. And those are good times when it's overheated to sell the covered call, because you would expect the stock to come back to you a little bit. And if you happen to get the stock called away from you because it just went straight up, well, then you took a profit, and that's okay too. So we're going to take a look at Lam Research and Nutrien, Raytheon Technologies, and then whatever else you want to. And we'll take a look at some of the stocks over here. And there are a lot of overbought stocks over here. 70 represents overbought. And then in the 60s, sometimes that can be overbought too when you compare time periods like daily chart to the weekly chart. So let's go back to our dividend plays. One of the things that you're going to want to be aware of is where are the call option premiums versus the put option premiums. And when this chart is trading down here, close to the red line, that means that calls are expensive relative to puts. Now, this chart is inverted. This is put to call. So it means that puts are cheap relative to calls. And what you can see when you go and compare option premiums, and we'll do a couple of those, is you'll see that call premiums are pretty high right now. And why is that? Is because the millennial trader who has doubled the size of the retail market in the last year and a half, 2 years, based on the number of trades that are being made by retail versus institutional versus hedge funds, you're going to see that you can get really good option premiums for your calls. So if you have a stock that's a little overvalued, a little overbought, and you think that maybe there's a little bit of a breather coming in the market where your stock might chop sideways or even fall a little bit in the short term, but you still don't want to give it up long term unless it gets even more expensive, then you write a covered call. And not necessarily against the entire position, but against part of the position. And we'll walk through some of the things that I've been doing over the last 20 some odd years that have worked out well. But this is a chart that I will pop up with frequency, because when this line gets up here and the puts are very expensive, that means the market is generally fallen and the puts are expensive, and it's a good time to sell puts because A, you're getting income, and B, you're getting a chance to establish positions at pretty cheap prices. So when the line is up here, we generally want to be put sellers. And when the line is down here, we generally want to be call sellers. So let's go take a look at a couple stocks. Somebody had me taking a look at Cadell today, suggesting that it might be a good buy. This is a stock that I would think that you could probably sell some puts on, because I don't think it'll get much lower than this range. This is right before it took off on testing for coronavirus. So this is one of the coronavirus testing stocks. Once we have a vaccine, you would presume their revenues would drop a little bit. And a lot of this was speculative run-up. So you can see how much speculative run-up can be run down. It got all the way over 300, came all the way back down to 150, 140. So over a 50% drop in the stock price. And that represented about a 60, 70% retrace of the gain. So now it ran back up because everybody's like, oh, gotta chase it, gotta chase it, gotta chase it. And now it's coming down. In my experience, over a very long period of time, over 25 years, when stocks behave like this, it usually indicates further downside. And I would think that this stock gets right around here. This 618 level, 125, probably is going to be pretty strong. I haven't charted out the more recent time periods. So, I think if you're looking at this one, you'd be very careful, but you're definitely, if this is a stock that you want, and it doesn't matter what stock we're looking at. When you look at charts, you just want to get used to it. When you see things falling off like this, it's so volatile, that's the indication that the market's undecided about this company. This area and this area look like it could be a good area that it would hold. So I think that as you get closer to it, you can sell the cash secured puts, and then you just have to decide how much risk am I willing to take. So you might sell some cash secured puts at 145 and collect a good premium, but you might also sell some cash secured puts at 125 and take some premium as well, and know that if these get put to you, that's a pretty cheap price. I wouldn't expect these to get put to you, but these 145s might. And now you've collected two premiums to reduce your cost basis from 145 to minus the two sets of premiums. So when you're selling cash secured puts, you're looking in reverse. And the reason I'm going to bounce back and forth is because I want you to be able to think in either direction, right? So we want to be able to think, okay, when I find situations like this where the puts are expensive, I should sell the puts. When I find situations like this where the calls are expensive, I should sell the calls. And you should be able to bounce back and forth. Let's take a look at semiconductors in general, because we know that over the last year, semiconductors have been on this heck of a rally since the bottom in March. And we can see that on daily RSI, it's almost overbought. If we switch to weekly, we can see that it is overbought. So this is a situation where we know that it's getting overextended. That doesn't mean it can't get more overextended, but it does probably mean that it's going to have a pretty significant retracement at some point. It happens every time. See, this one went a little further and then it came down. So you're probably in a position now where selling covered calls on semiconductor stocks is going to make a lot of sense, because not only is it overbought on the weekly, it's probably about to become overbought on the daily. And when those things coincide, it usually means that one will drag the other one down. Lam Research has just been a dynamite stock. If you bought it down here, you've made an awful lot of money. You've doubled your money. But now you're in a position where you're like, well, I've doubled my money in 7 months. I know that the sector is overbought. I know the stock is probably overbought. Again, you pull up your relative strength index. You see that on the daily it's overbought. See on the weekly it's just getting to overbought. And if you want to do it based on volume, which I usually do, take a look on the money flow index, and it's overbought on a daily. And it's not quite there on the weekly, which means that the daily could, have another rally, could do that, and pull the weekly up a little bit further. So a question you have to ask yourself is, how greedy are you? When you see a chart like this, you have to say, okay, what do I know about the company fundamentally? Well, we know that this is a great company fundamentally, right? They're in the fabricating of semiconductors. They're just a very good company. These bars on the side are the volumes of the trading activity. When the yellow, which is the selling pressure, is bigger than the blue, which is the buying pressure, then you know that there's more sellers than buyers. So right about here, you start to see that the blue is a little bit bigger than the yellow. So this is where you get huge buying pressure. You'll notice that the volume and that MFI that I showed you a second ago kind of indicated this. The volume hasn't been all that great at all these prices. So with Lam Research, what we know is that there's a lot of momentum investors in this, and they're buying a lot of calls. And that's why volume can be lower. That's why money can even be coming out of a stock and the price can still go up, because the calls and the leverage push stock prices up. The same way that happened back in 2006 and 2007 and 1999 is you had people borrowing money to buy calls. That's leverage on top of leverage. That should make you think, wow, that's very, very dangerous. And it is. So with the Federal Reserve getting money taken away from them from the Treasury Department and having to wind down the corporate bond support and the municipal bond support, the Main Street fund basically is just getting wiped out. They don't care about small companies. You're seeing the likelihood that we have a lot less liquidity going into early in the year. Now, that'll be offset by some retirement plan contributions, which is what the January effect essentially is. And then in the end of January, Janet Yellen will become Treasury Secretary. And she'll be acting secretary right away. And then she'll have to get Senate approval. I can't believe that she wouldn't get Senate approval, so I'm not too worried about that. There'll be plenty of Republicans who would support her, regardless of how the Senate turns out in January. So you're going to see liquidity again from the Federal Reserve, because the Treasury is going to have a friend there. So I would expect that you're going to see as much fiscal stimulus as the Democrats can get done based on how the Senate is situated. But also the Federal Reserve isn't really going to back off all that much. So there's going to be this little itty bitty window in January where you might see some hiccups from the liquidity becoming a little less liquid. But Janet Yellen, remember, she said, all this liquidity is causing the 401k balances to go up. Is that a bad thing? And that was, in essence, what she said one time in a press conference when she was Fed chairman. So the question I think we have to ask is, are we eventually, as the world normalizes, are we eventually going to see a reduction in the speculation that's out there? I think we're going to continue to see rotation in the stock market. And as employment numbers come back up starting next summer, I think you're probably going to see even more pressure on stocks to go up. So what would cause the big correction that I really worried about for a long time? I think it's really just going to be a return of price discovery based on normalization. And people have a hard time wrapping their head around that because they say, well, but the economy will be getting better. Yes, but that's pretty much already priced in, correct? If people are looking forward to a better economy than we have now, when it's better, what will they look forward to then? What if the economic numbers are choppy even after we've had a little bit more rebound? What if liquidity is a little bit less? What if there's pressure on interest rates from the private markets to go up? If we really have a hard time with the municipal bond markets, which are a big deal, then we have to worry that if there's a logjam in Congress, that there won't be a bailout coming anytime soon to preempt a crisis. They would, in fact, wait for the crisis to do the bailout like they did this time. We knew 6 weeks ahead of coronavirus, the government for sure knew, because those two Georgia senators were trading on the news in January. We knew that we had to do something weeks and weeks and weeks ahead of time. And we even knew during the financial crisis, because I wrote about it the January before the financial crisis, that we had a huge problem. Other people were talking about it years ahead of time. So we typically react to a crisis. We don't usually prevent the crisis. We'll see what happens. If you are truly a risk-averse investor, stocks like Lam Research, you should be trimming right now. But if you still want to hold on to part of the position, maybe write covered calls against part of it. What I would suggest would be pretty worthwhile. Let's suppose you bought Lam here right around 200 bucks, right? And you've doubled your money. I can very easily see taking a third of your position off, writing covered calls against about half of the position, and then just leave 1/6 of your position unencumbered, in case it continues to spike up. So that 1/6, 1/3, 1/2 model, I use it all the time. I will sell a third of my position. I will write covered calls against half, and then I'll leave about 1/6 of my position available for irrational spikes. And that's after I've seen some appreciation. Now, could you buy the stock right here and then write a covered call? You could, and that's what a lot of people who have buy rights programs would tell you to do. I would never do that. Why would you buy something that's already overbought? Here, it was oversold. Could have bought it down here and sell it up here. And remember, this is a weekly chart, so this is a pretty long time frame. When these weekly charts get overbought, you usually get a correction. So you can see where my little hand is pointing to the overbought, and then it comes down. So now we're at overbought again. If you do that, sell a third of the position, write cover calls against half, and then keep 1/6, right? Because these aren't perfect, but they're pretty good, and it could go up a little higher. And if it does go up a little higher, then maybe you sell that 1/6, scaling in, scaling out. Don't try to be perfect with one trade. Give yourself some margin for error by having kind of a spread of things. When you try to be too perfect, you hurt yourself. I just tried to be perfect on some option trades with puts on oil stocks. I wasn't perfect. I got waxed. I lost 30, 40% of my position. Granted, it was 1%, 2%, 3% of portfolio, but it is still, not a good feeling to lose that kind of money because options move so fast. So I speculated when really I should have just been selling the insurance. And that's what you're doing when you're selling a covered call. So you're selling some insurance, right? I take that back. I want to restate that. You are selling some speculation to somebody else, right? Somebody else is looking to speculate. on the stock continue to go up. Don't want to mix up my message here. I was speculating by being the buyer of the options. When you're selling the option, you're basically like the house at a casino. You're funding the addiction. Sell calls, sell puts. So one of our holdings is Nutrien. I think Nutrien, I've said all along, is going to go up to here, but it's overbought on the daily. It's almost overbought on the weekly. The reason we own Nutrien is because that market has tightened up a lot. There's clearly some upside to go here, but it's going to run into some selling pressure because a lot of these people, right, this is old data, this is from back here, that means that they're going to want to get back to even. So you're going to see some selling pressure as it goes up. So if you wanted to say sell, say, a $50 covered call, which is right here at this 0.5 fib line, which could definitely do a reversal. Do a reversal right here at the 618 line. But you can see these are all people who bought at these prices and they want to get back to even. So if you sold the covered call into here, say January, and we got some jitterbugging to go on because of the Fed, because it's overbought, because you have sellers that want to get back to even, redeploy their capital somewhere else, something that didn't feel too good for them, right? And people are emotional. So folks who bought in here and it went down here, they're like, oh, I just want to get back to even, you know? And the reality is it probably is going to go a little higher. But if they're selling in here and then it pops out, you know, how much higher can it go? In the short run, probably not too much higher. In the long run, I think it's a great company and an oligopoly. But if you're looking to add income and you identify selling pressure coinciding with an overbought signal, sell the covered call, you know, so I'd say still January $50 covered call. Probably not going to get much for it, but today is a good day to do it. All these stocks are running. And I do use Yahoo instead of NASDAQ or my trading system. It's just so easy to use and so easy for you to look at. So your $50 covered call is going to get you over $1. You're taking 2% income for 2 months time frame. It's pretty good. Annualized 12% rate of return on a covered call. You're adding a pretty big dividend there, correct? And when you take a look at Nutrien, it's got a good dividend yield, $1.80 a year, and you can add $1.20 just through January. Now, let's suppose it gets called away on you. If it gets called away on you, then you just wait for the stock to have a little correction. And when it's oversold on a daily chart, you can probably sell a cash secured put. But for sure, as it approaches oversold on a weekly chart, you can sell a cash secured put. And again, I would use these volume bars and these adjust based on the time frame you're looking at, right? So you want to go back to a relevant time frame. This is the merger with Agrium, so you can pretty much get rid of that. So right in this is the area. Probably go back to here, late 2018. 2-year charts are very good charts to use. They tend to work over and over and over again. I don't know why they don't have a preset for 2-year. I'll have to check and see if I can jam that in there. But again, you'll see big buying pressure in here. So if you sold a cash secured put, let's say it comes down to here, there's some selling pressure there. Stock gets back in here, I think you would sell a $40 cash secured put, collect your premium, have a net cost of 38 if it gets put to you. That's pretty good for this stock. You know, can it get down here? Sure. I think it's unlikely that it happens again. But right here, as you run into this big selling pressure, this is the type of pattern you want to look at, right? From here to here is increasing selling pressure, then the selling pressure decreases again. But we don't know if there'll be buying pressure that develops up here. What we know is that we've got this glut of people who bought in this range who want to get back to even. Think about all the times that you've had a stock that did this to you, and when you got back to even, you're like, I'm just going to get rid of it. What you should do is reevaluate the story. And people who follow Nutrien know that they're in a great position. One of the things you can do when a stock is going up like this and you already own it and you're going to sell a covered call, you could simultaneously sell a cash secured put down here because you're creating a gap between what you buy and sell it. Now, you still don't want to sell the cash secured put too high. Ideally, you would have sold it down here at the latest. But if you sold the cash secured put at 40 now for January, 2 months time frame, you're going to get a 2% rate of return on a covered call. You're adding a pretty big dividend there. you'd only get 30 cents, but it's 30 cents. And if the stock keeps running up, it's just money in your pocket. Plus $1.20 here for 2 months, you've almost collected an entire extra dividend for the whole year. The dividend's $1.80. So these transactions can add up, and you only need to do them per stock a couple times a year, maybe 3 times a year, because you're not going to get the overbought and oversold signals much more than that. So if on each position you essentially doubled or triple your dividend for the year, you know, from 2% to 6%, 3% to 7%, things like that. If you're dropping an extra 3, 4, 5 points to your bottom line every year, and it serves as a way to manage risk, that's a pretty nice deal. Those 3, 4, 5 points, I mean, that's way more than, you know, the treasury bond. So that's just free money, and you're selling stuff from time to time on rallies. Again, remember to break your positions up. Don't write a covered call against your entire position. Maybe against half of your position, and then decide, should I sell part of it as well? This was one of the new stocks that we got added on to our stocks of the week yesterday. So this is a company that I followed for years, fell off a cliff. It's a REIT, pays a pretty good dividend, fell off a cliff. And it just started rallying in the last week or two because I think because a lot of newsletters are hyping this company. It's a New York area based REIT, and a lot of their strip malls are anchored by grocery stores. I think you can probably buy it up to here, and then it could probably rally out to here pretty easy. And this is where you're going to see selling pressure. But this is a very fast jump, so you'd expect a bit of a pullback. So if you already owned this REIT today, you know, with it being up, is it really up 15% again today? You could sell the covered call and probably sell it all the way out here to 20. And I bet you get a little bit of premium. Let's take a look. Sometimes it doesn't work, sometimes it does. But on these huge rallies, you have to go out to February with this one, I think. Now, there's no premium in this one yet, and not much of an options market. So you just ignore stocks like that. Question here is, do you want to buy it? Because it could probably run to 20 pretty easy. Another stock that I added to our list, and look what it did today. It's up 27% today. My buy orders are in at 17. This is one that if you had bought yesterday and you got this jump, I'd probably just sell the stock, or at least 2/3 of it. It's going to be years before this company is able to execute on their plans. And between now and then, the market will have a normal moment. At some point, the market doesn't go straight up. At some point. And now that I say that, it will for, you know, 3 years. Market will probably triple in the next 3 years. So I do this on ETFs all the time. Somebody asked. So we can take a look at the various spider ETFs. And I'm looking to see which one might be ripe to sell a covered call on. So you have the technology. Go back 5 years, huge buying pressure down here, and decreasing buying pressure as you go up. Let's just take that to 2 years. I want to include the fourth quarter of 2018 because I think that's important. You know, I was going back to 2016, that flat period in the market. You know, stock market was flat here, 2015-16. It's just rallied big. And I think that this is probably okay. But this range here in 2018, I think that's the range that we have to be concerned with now. So your chart should go back to the end of 2018 because it's an important period. It'll show you where the huge buying pressure is. It happened again here. Obviously, it happened in here. You want to take a look at technology. You say, okay, came off a little bit. Back here would have been a great time to sell covered calls, right? So it really hasn't gone up much since then. So you see where it was overbought. If you had sold covered calls here, you know, for 2 months out, I usually don't go more than about 2 months out. Anywhere from about 6 or 7 weeks to, you know, a little under 3 months, 2 months-ish. That's what you're looking for usually, because then you can game the earnings seasons a little bit. Say, that premium would have just ended up in my pocket because the stock would not got called away from me. And now the question is, would you do it again? I'd probably write another covered call on XLK right here. So you go pull up the handy dandy Google. Actually, this one's, like I said, Yahoo. Say $120 covered call, get $5. Go a little out of the money, get 253 against a $1.25. How much is this paying in dividend every year? Almost nothing, right? 1%. So 253 divided by 125, you're adding 2% for, again, about 2 months. Annualized return of 12%. See how powerful these covered calls can be when you do them at the right times? Anytime it's overbought, you should look, right? Overbought on the daily, you should at least look. And that's when you pull out this chart and say, okay, what is it saying to me on the weekly? So technology is actually overbought on the weekly, even though it's been choppy on the daily. It's more ripe to fall than it is to rise. But again, we have this super juice FOMO liquidity market. Doesn't mean that it can't go up a little higher. I have pretty much never seen a sector continue higher when both the daily and weekly are overbought. Almost never. And maybe the once or twice per decade that it happens where it keeps rising, that's usually setting up for a horrific event. The types of events that we saw at the end of 2018, right? Doesn't look so bad anymore, does it? Let's take a look at what RSI did way back then, though. So if you go back to the end of 2018, it was overbought on the daily and way overbought on the weekly. Then it just kept coming down throughout the year. So these are pretty reliable indicators, even though they might not always trigger right away. And that's why you just have to be willing to let something get called away once in a while, knowing that I'm within a couple of months of this thing coming down. Cash secured puts on Ford. Well, Ford, which I've been yelling at people to buy all year, is running into, let's go back to the end of 2018, okay, is about to run into some areas where people might have some selling pressure. If you want to trade this one, I think you could write a covered call for like $12 if there's any premium. You won't get anything though. And you get 3%, 32 cents against $10, 32 cents against the $10 covered call. And this guy asked about cash secured puts, and you're not really getting anything for the cash secured puts. I think that this run up is pretty dramatic. Take a look at your relative strength index, overbought on the weekly, overbought on the daily. This is a stock that, depending on my position size, I would be inclined to write some covered calls, probably to 10 for January, because we know that they're going to make their big product announcements in the spring. They've already told us that. We know that there might be a little bit of weakness here in the short term, but I do think that folks are starting to wrap their head around the arguments that I've been making for 10 months now of why Ford is so attractive. So on a stock like this, I'd be inclined to probably do nothing, unless it had grown to a really big position for me, right? If all of a sudden you've got 5 or 6% of your money in Ford, go ahead and write covered calls against half of it. But if this is a 2 or 3% position, which is what it is for me, I don't think you do anything with this. I just don't think there's much to do, even though it's overbought on both the daily and the weekly, because I like the fundamental story that much. Again, you want to collect some premium for the short term, write the January $10 covered call against half your position. It's a 3% equivalent premium. If it's half of a position, that means you're dropping 1.5 points to the bottom line. So again, it depends on what your goals are. If your goal is income generation and managing risk, I would sell half of the position covered call, covered call against half the position. I don't think I'd sell any Ford stock though, again, unless they become an outsized asset allocation for you. Ford is one of those companies that I think might go to 40 or 50 in the next 5 years. And I really think it could be a 10 bagger from where I bought it, be a 5 bagger from here. Right, Ford might also reinstitute a dividend. I don't think that comes till the very end of next year or the year after, though. I think it's going to be further out than people think because they want to buy back shares. So Ford wants to buy back shares before they reinstate the dividend. So I don't think it bothers them that their shares are cheap right now, but they want those shares to go up by the end of next year, right? Because of corporate executive bonuses. And the executive bonuses have been dialed back to, their options are priced down here now. So if they can buy back a bunch of shares and then reinstitute the dividend, I think Ford is in awfully good shape. So again, it's hard for me to risk my Ford position, given that I think the upside is so big. It's one of those rare positions where, I just want to trade around the edges maybe, but not much. What other kinds of questions do we have? What other stocks would you want to look at? What do you have that's overbought? Anybody buy Roku? Anybody buy Ulta when we talked about it? Roku, I think for sure you can sell covered calls. I mean, you should be trimming some of your position. Again, it depends on what your size asset allocation is. But you throw Roku in here. And remember, we've talked about how it's going to take time for them to monetize. I would probably sell a covered call at the money, collect this 647, get your 2.3% on a stock that doesn't pay a dividend for half of the position. I'd probably sell a third of the position, and then you keep your 1/6 in case it keeps going crazy. And eventually, because we know that overbought signals on the weekly and the daily, when they coincide, you're usually within a month or two of a correction. Pretty good one. And I think that we've looked at enough charts now that we see a lot of these are up here. If you take a look at the SPY, this is why I was trying to short it. On the daily, it's almost overbought. On the weekly, it's almost overbought. So what we could see through year end is these both getting pulled up into here. And that's when you actually might want to be the speculator on things going down, because puts still be cheap. Somebody asked about QQQ. So almost overbought on the weekly, but it was, and it came down. And on the daily, it's not really close. So I don't really see a put selling strategy here or a call selling strategy here. I don't think there's much to do with QQQ at the moment. You see that as this falls, there could be a lot of sellers through about 260, right? And in fact, I think I would raise my buy to here as the optimal zone, then up this 618 line where you have a confluence with another level. So I do think, you've seen me do it in the last several weeks. I've pulled some of these levels up. I think we're going to get in here. And the question that we just have to keep asking is, how low is this going to go? I think that by February, you have so much stimulus coming again, even if it's just the Federal Reserve, that they support these markets, but they might be in a choppy range all of next year. The one scenario that I worry about, which is why I'm still not deploying all my cash, is that if there's no fiscal stimulus and Jerome Powell decides on his own that he's going to normalize, then you have a pretty dicey situation. I don't know how much Powell is going to support the markets after Trump. Is he a Trump loyalist, or is he actually trying to do a good job? I don't know. I do know that it makes sense for rational price discovery to come back. I don't know how we get there. So I guess I should leave this here. It's a pretty wide range of outcomes. Somebody asked about ARK. So what do we look at? We look at Tesla. You want to compare it to something? Here, compare it to ARK. Tesla keeps pulling ARK up. I would like to see ARK performance excluding Tesla. That would be interesting. So Tesla is adding another Ford to its market cap today. Overbought both the daily and the weekly. Does it even matter? And this stock is the poster child for parabolic price moves. And the question you need to ask yourself is it justified? I don't think so. Remember, this is where we talked about buying it a long time ago. Long time ago. Almost a year and a half. So we talked about buying it down here. I know a handful of people did. I sold it at, here, actually. And then it went like that. So I understand the companies. Sometimes I don't understand the market. The liquid irrationality right now is off the charts. Honestly, if I own Tesla right now, I'd have to sell 90% of it. So what does that say about ARK? Yeah, see, it's become choppy. You're in a seller zone. And you might be seeing the last hurrah for the stock market right now. I thought that 3 other times. But all the technical charts are telling you sell covered calls, trim your positions. We don't know if ARK is selling or not. You know that for ARK, you can subscribe to their daily trades. Go to their website and subscribe to their daily trades. I haven't looked at it in a couple days. PBW, again, a lot of these, this is probably safer than ARK because I think clean energy is going to be the big story in the 2020s. How high do I need to raise this? You know, irrational is irrational. You're going to get big selling down in here though. So where is a sensible line to buy? I guess that's a 168 line. I guess we could go there. We can raise this to here. 0 line. Yeah. I mean, this is almost saying that these levels are irrelevant now. Raise it up to the 618. That's this one. There. I'll update this chart. Did I miss it? There we go. All right. Any other questions? No? Okay. But I think this should be screaming out at you. Sell covered calls right now. Trim positions that are too big. Back to what you think they should be in your asset allocation. Most stocks should be 2 or 3 or 4%. Probably closer to 2 than 4. And selling covered calls, which are very expensive right now, through some of the unknowables on the transition probably makes sense. All right, everybody. Have a great Thanksgiving.